Welcome to this training and the first video about the concepts of credit risk. My name is Christian Rummer and I'm one of the co-founders of the company Q-Lana. We think that it's both a basic knowledge as well as an essential part of understanding the entire concept of credit risk management. And credit risk is probably the most important risk category in a lending-focused financial institution. So these concepts will also help you to define the methods that you will need to steer your financial institution from a risk and pricing perspective. We have split this training into 5 sections, which are built on each other and in the end deliver a complete picture of the concepts to you. There is also an introductory video, you're listening to this right now, and a summary video at the end. In the first video, we will start with a formula to quantify the credit risk, before introducing the expected and unexpected loss concepts. Those concepts are essential because we will need them to translate the unexpected loss calculation into a way to quantify the capital requirements you have for a portfolio as well as for individual loans. And finally, we will use these results for the pricing and the calculation of a risk-adjusted return on capital, which is also known in this abbreviation, which is called the RAROC. The first parts of the training are not very mathematical, don't worry about that. You will be able to follow them with a basic knowledge of addition and multiplications. It will get slightly more complex towards the end when we introduce the formulas used for the calculation of the capital requirements for individual loans. But we will try to make this as simple as possible. We will be using visualizations and comparisons so that the overall concepts remain very clear for you. In any case, we can already commit that you will be able to understand the concepts that we try to communicate and educate here without the full understanding of the detailed math used in the individual formulas. From our perspective, it is actually a quite good idea to have a decent understanding of the subject. Think of it. Whenever you offer a financial product, whenever you generate revenues from lending or from many of the other financial services that you offer, you are actually taking risks. So you are in the business of taking risks as a financial institution. And of course, for these risks, you need to get properly compensated. So you need to understand the risks, you need to quantify the risks, and then you need to find the right price for those risks. In other words, we are looking at risk taking similar to, let's say, an insurance company. And for the sake of the example here, let's go to a car insurance company. And as you have probably experienced yourself, the insurance companies have quite a differentiated pricing structure. You might get a cheaper insurance if you are a little bit older or have navigated your car without major accidents for the most of the time. And similarly, if you are a younger driver or if you had a couple of traffic incidents which resulted in claims against the insurance company, then your premium will of course increase. In our training here, we will look at comparable concepts for financial institutions, and we will go even deeper so that you have a fundamental understanding about the ways your financial institution can be steered using a decent understanding of risk and deriving the pricing from that. We think that not only will this provide some clarity for you, it will also push you ahead to allow you to have a better understanding of your financial institution. And by that, you will create a lot of respect for your skills with your colleagues and your teams. And ultimately, you will be far more respected by your customers and your competitors because you will be able to offer fair and transparently priced products. That's just the introduction. So let's get started with the first chapter. We look forward to seeing you in the next video.